Hello and welcome to Lesson 2, Taxation of Earned Income. By the end of this lesson, students should be able to identify the various sources of gross income from employment, describe the tax consequences of self-employment income, describe tax attributes of various fringe benefits and the non-discrimination provisions that apply to them, describe the tax attributes and advantages of various retirement plans, and describe the tax consequences of stock options. So first, let's start with the definition of gross earned income. Earned income can be salaries, wages, commissions, fees, and tips, anything that's paid in cash. But in addition, it can be non-cash property, services, or benefits. Now, the person who earns gross income, who is considered an employee, will have that income reported to him or her on a W-2, and a self-employed person will have gross earned income reported on a 1099. All U.S. citizens are taxed on their worldwide income regardless of where it is earned, which means that U.S. citizens working abroad may be subject to income tax in a foreign country and certainly are subject to U.S. income tax on that earned income. But Congress has provided for an exclusion amount for a certain amount of foreign earned income. If it's taxed in that foreign country, it can be excluded from U.S. income. But in order to exclude part of the foreign earned income, the earner must meet either the bona fide residence test or the physical presence test. There are some very strict numerical rules to follow, and basically the bona fide residence test means that the taxpayer states that they have, for all intents and purposes, moved to the foreign country. They have not relinquished citizenship, so they are still U.S. citizen and subject to U.S. tax on worldwide income, but they intend to stay in the foreign country for an indefinite period. By contrast, the physical presence test is for taxpayers who say, I'm here temporarily, however, I have been out of the United States for more than 333 days out of a calendar year. That doesn't mean they need to be in the country where they're earning the foreign income. It just means they cannot be in the United States. And if an employee meets either the bona fide residence test or the physical presence test, in addition to having a certain amount of earned income excluded, the foreign housing provided by the employer may also be a benefit that is excluded from income. And most of the time we're talking about professionals, managerial and above, who are moving to a foreign country and working abroad. So typically their earnings are going to be higher than the exclusion amount. When that happens, there is the possibility that the taxpayer can have a foreign earned income credit for the amount of foreign earned income that is taxed both in the U.S. and in the foreign country. In addition to that compensation that we've talked about, not all compensation, as I mentioned, is cash. Some is in the form of fringe benefits. So fringe benefits are additional benefits that employers provide to employees as incentive to stay with the company and as compensation for services. Fringe benefits are generally considered to be taxable unless they're specifically excluded by the tax code, and we're going to spend quite a bit of time talking about some of those excluded benefits in just a minute. But the important thing to keep in mind is that in order for a fringe benefit to be excluded, it must be offered on a non-discriminatory basis. So that means it can't just be for the officers, for the highly compensated employees. It must be offered to the rank and file employees as well. So let's take a look at some of the fringe benefits that employers offer. The most common employee benefit offered by companies, or historically it's been the most common, is of course the medical fringe benefits. We're all familiar with health insurance. It's a big debate in the news right now. In addition, many employers offer a health reimbursement arrangement where an employee can submit unreimbursed medical expenses for doctors, prescriptions, qualified medical expenses, and the employer will reimburse the employee for those expenses. Those reimbursements are not considered to be taxable income because that's specifically excluded by the tax code. Similarly, health savings accounts are becoming more and more popular as something that's offered by employers to employees, and we'll take a closer look at health savings accounts right now. So health savings accounts go hand in hand with qualified high deductible health insurance. So you can't have just any old type of insurance or no insurance and be eligible for the health savings account. That's why it's becoming more and more common for employers to offer this benefit, because employers will know whether they're offering the insurance that allows employees to take advantage of the health savings account. The nice thing about health savings account is the contributions are tax deductible, and the tax deductibility does not depend on a taxpayer's income, which is nice. Many tax benefits that we will learn about in this term are limited based on income, but it doesn't matter what your adjusted gross income, what your taxable income is. There's no limit on the ability to deduct your health savings account contributions, no income limit. There is also no use it or lose it provision. So you may be familiar with the flexible spending accounts where employees can make an election to have a certain amount withheld from paychecks each week, each month. But if the employee doesn't use the money in their individual account by the end of the year, they lose it. Health savings accounts allow you to contribute money to the account and keep it on an ongoing basis. And you can take money out anytime for qualified medical expenses if you continue to roll your balance forward and you reach age 65 and you still don't have any qualified medical expenses that you would like to be reimbursed for, or you have excess amount in the account above your reimbursable expenses. That amount can actually come out to you kind of like an IRA distribution. So you would pay ordinary income tax but no penalties. So I like to think of it as an additional IRA, but you can use it for health, to pay for health benefits as well. Of course, we can't leave the topic of health benefits without talking about healthcare reform. Beginning January 1st of 2014, all U.S. citizens and residents will be required to have health insurance, and this will be enforced by a penalty for those who don't comply, which will be assessed on the 2014 tax return. Now, as I'm sure you're aware, following the news, there are many things about the new health care reform and health care coverage that have not been worked out. Lots of logistics. Many of those logistics have to do with the collection of the penalty. So be sure to stay tuned over the next year to see how healthcare reform plays out and how it will be reported on 2014 income tax returns. So there are other types of insurance that employers typically provide employees other than health insurance. The most common are group term life and disability insurance. So the important thing to know about group term life insurance is that the value of coverage over $50,000 of death benefit is actually considered taxable income to the employee. You'll see that added to the W-2, and so if an employee thinks that he or she has earned $100,000, if they have $100,000 of group term life insurance coverage that the employer is paying for, they'll actually see taxable income of a little bit over $100,000 because the value of that extra $50,000 of life insurance coverage is being added in. Disability insurance can be paid for in two different ways. The employer may pay the premiums. In that case, typically it's not included in the employee's gross income or taxable income. And if that happens, if the employee ever goes on claim and benefits end up being paid out, those benefits are taxable because there was a tax deduction by the employer when the premiums were paid. If the employee is able to purchase disability insurance, they may have a choice of whether they pay those premiums with pre- or post-tax dollars. This is where you as a financial advisor can add a lot of value. Typically, you would want to advise your client to pay with post-tax dollars. If the employee pays with post-tax dollars, the benefits then are tax-free should they ever go on claim. If they choose to pay with pre-tax dollars, then similar to when the employer pays, those benefits would be taxable. And of course, if a client is on disability, their income by definition is reduced because disability benefits can never be more than a certain amount of earned income. And probably they have additional expenses too. So whenever possible, you want to advise your clients to pay for disability insurance premiums on a post-tax basis. Now, in addition to insurance, employers do offer other types of fringe benefits. Some of the most common are cafeteria plans and flexible spending accounts. So the cafeteria plan is a document, a legal framework that allows employees to pick and choose the benefits that they want to purchase through the employer, and they pay for those benefits on a pre-tax basis. So obviously health insurance would be one of those benefits, perhaps some sort of health savings account, health reimbursement account, dependent care benefits, and there could be some other benefits that the employee can choose from a la carte, and those payments are made pre-tax. And pre-tax is very beneficial because that reduces gross taxable income, and as we learned in the previous lesson, it is more valuable to have a deduction for AGI than a deduction from AGI, which is what in effect cafeteria plans allow employees to do, have deductions for AGI. Health savings accounts, flexible spending accounts are similar to health savings accounts, but there are no specific insurance requirements, so you could have a richer health insurance plan and be able to take advantage of the flexible spending account. But as we mentioned in the previous slide, there is the use it or lose it provision. So when an employee is making an election for deferrals into the flexible spending account, and usually that happens in the fall for next year, they need to be conservative because they don't want to put too much money into the account and then end up having to spend money that they wouldn't otherwise spend, or to lose the dollars altogether. There are some other fringe benefits that are fairly common that employers provide. They include meals and lodging for the convenience of the employer. So a great example of this is a CPA firm. Typically, CPA firms during tax season will provide breakfast on Saturday, maybe lunch on Friday, maybe they'll have a staff meeting where they bring in food, and that's really for the convenience of the employer. The employer wants the employees to be more productive, to put in more hours, and so they make it a little bit easier by providing those meals. Another type of fringe benefit that's not taxable to the employee is the no additional cost service. So I believe your textbook talks about the unused seats on airlines. Another common example would be an employee of a movie theater. So the movie is showing anyway. If there are a couple of extra seats, there's no additional cost to let a movie theater employee sit in those seats. And then finally, qualified employee discounts. The discount can be no more than 20%, but it is not includable in the employee's gross income. And here we have a few more fringe benefits. Your textbook covers them in detail, but these again are non-taxable fringe benefits, and they include working condition fringe benefits, de minimis fringe benefits, qualified transportation benefits, athletic facilities, educational assistance, dependent care assistance, and employee achievement awards. So another major benefit that employers often offer employees is the employer-sponsored retirement plan. And I'm sure you've learned quite a bit about this in your other classes, and certainly in your careers, maybe even in your college jobs. But employers and employees can generally make contributions to retirement plans tax-free. So this is an instance where Congress is promoting the social value of saving for retirement, saving for one's own retirement, by giving a tax break. There's a deduction and no one is picking up income, at least currently, as we've discussed previously. Plan distributions are generally taxable to the employee. However, if the employer establishes a Roth 401k or a Roth 401b, then those distributions come out tax-free as well. And we'll talk more about Roth accounts later on. But just know that Roth 401ks and Roth 401bs are becoming much more popular over the years as employees want more options for saving for retirement and as computers make record keeping a lot easier, so it's not so difficult to offer both the traditional and the Roth option. So moving from retirement benefits to other incentives for employees, let's talk a little bit about incentive stock options. Now, incentive stock options are not very common. You have to meet specific criteria. The major criteria that must be met for incentive stock options is that the exercise price must be at least the fair market value at the date of grant. So these are less common options than non-qualified stock options, and typically you'll see incentive stock options for managers and higher level employees. As the name suggests, it's an incentive for the company to do well so that the stock price does well and the employee in turn financially benefits. The nice thing about incentive stock options is there are no regular tax consequences when the employee exercises the options. And if the stock is held for at least 2 years, the employee gets capital gain tax treatment as opposed to ordinary income tax treatment. So this is a way to reward key employees with tax-preferred income. So rather than just giving a bonus that's taxed as ordinary income, you're allowing them to potentially have compensation taxed as capital gains. So let's contrast incentive stock options with non-qualified stock options. Non-qualified stock options are more common. You may have many clients who are rank and file employees of Fortune 500 companies who have the ability to take advantage of non-qualified stock options. And what happens when an employee exercises non-qualified stock options is that they recognize ordinary income. In fact, they recognize compensation. So that's subject to ordinary income tax and it's subject to payroll tax. But once the options are exercised, when the stock is sold, it obviously is considered either short or long-term capital gain, depending on how long the stock is held. So this is a way that all employees who have the ability to take advantage of non-qualified stock options can benefit in a tax-advantaged way from investing in the company. Now, the last concept that we'll talk about for gross earned income is Social Security benefits. And technically, this is an income that you earn currently that you're receiving, but it's based certainly on income that you've earned in the past. So Social Security benefits may be partially taxable depending on the taxpayer's other income, and that's called the modified adjusted gross income. And so Social Security benefits could be taxed at 0%, half the benefits could be taxed, or 85% of benefits could be subject to ordinary income tax. So in this module, we've learned about the various ways employees are compensated and how various types of compensation are treated for tax purposes. And we also learned a little bit about the taxability of Social Security benefits.